Hey everyone, welcome back to Corporate Decoder, the place where we make sense of those confusing corporate filings. Today, we're diving into a report from the Federal Home Loan Bank of Chicago, or FHLB Chicago. Get ready because it involves something called consolidated obligations. Don't worry, we'll break it down. It might sound like they're consolidating their debt, but it's actually about how they borrow money. This report is called a Form 8K. It's like an something important happened, report that companies file with the government's Securities and Exchange Commission. This one is dated February 12th, 2025. The filing is from the Federal Home Loan Bank of Chicago. These banks are part of a system that helps provide money for housing. They don't get money from regular people depositing their money. Instead, they get money by selling debt. They're saying this report is about a direct financial obligation, which is just a fancy way of saying debt or what they owe. FHLB Chicago, like the other federal home loan banks, gets most of its money by selling something called consolidated obligations. Think of these as IOUs or bonds that they sell to investors. These consolidated obligations are basically how they borrow money. Now, here's a key point. All 11 federal home loan banks are jointly responsible for these consolidated obligations. This means that if one bank can't pay, the others have to chip in. They're all in it together. The Federal Housing Finance Agency, FHFA, makes sure they follow all the rules and regulations. The government doesn't guarantee the money borrowed, so it's up to these banks to ensure the borrowed money is paid. There's something called Schedule A in the filing, and it lists all the bonds and short-term debt the banks plan to issue. Now, the bank is warning us that this report might not give you the full picture of their debt situation. This is because they aren't necessarily reporting all of their short-term debt in this report, which matures in less than a year. Also, they may use financial tools to manage the interest rates on their debts, but those aren't included here either. Finally, the amount of debt listed here might not match the amounts in their official financial reports. This is because of different accounting rules and the effects of things like discounts. Let's move on to what's actually in Schedule A. There is a lot of data to unpack. The first entry, dated February 12th, 2025, involves a bond with the identification number 3130B54N5. It was agreed to on February 12th, but was settled a week later on February 19th. It's due to be paid back on February 19th, 2027, and the next interest payment is due August 19th, 2025. The bank has the option to pay it back early, and it is considered Bermudan, meaning the bank can choose to pay it back on a specific date. It has a fixed interest rate of 4.625%, and the total value of the bonds the bank plans to release is $15 million. The next bond has ID 3130B54U9. The next interest payment is due March 20th, 2025. The value of the bond is $1 billion. Then the report mentions bond 3130B55C8. It will mature on February 25th, 2037, meaning it has a longer lifespan, and the value the bank plans to release is $35 million. Bond 3130B55D6 has similar characteristics such as being redeemable and having optional principal redemption with a value of $15 million. There are a couple more bonds, such as 3130B56D5, valued at $150 million, and bond 3130B56H6, valued at $200 million. Finally, the list ends with bond 3130B57C6, maturing on August 27th, 2027, valued at $10 million. After the long table, the document provides a key. It's basically explaining what all those terms in the table mean, like optional principal redemption. The description for optional principal redemption means the bank can choose to pay back the bond early, either partially or fully on specific dates. There are also indexed amortizing notes where the payments change based on a specific index, or scheduled amortizing notes which have a set payment plan. The key also explains the different call styles, such as American, Bermudan, and European. It defines the dates on which you can pay off the bonds. Then there is the rate type description and rate subtype description. For rate types, there is conversion, which means the interest rate can change. Fixed bonds generally pay interest at constant rates. Variable interest rates pay at different rates through the bond's duration. The subrate describes zero coupon, capped floater, and others, which explain the type of rate the bank will pay to the bondholder. So what does all this mean? Well, FHLB Chicago is basically borrowing a lot of money. In total, the bank is planning on releasing around $1.4 billion in debt. That's a significant amount of money. They're using a mix of different bonds with different lengths of time before they need to be paid back, different interest rates, and different ways they can be paid back early. This helps them manage their overall debt and interest payments. Now, let's step back and look at the big picture. FHLB Chicago plays a crucial role in the housing market by providing funds to its member institutions. Their ability to access the debt markets at reasonable rates is vital for them to do so. One potential weakness is their reliance on these consolidated obligations. If interest rates rise, it could become more expensive for them to borrow money, potentially impacting their profitability and ability to support the housing market. On the other hand, the fact that these obligations are jointly backed by all 11 federal home loan banks provides a degree of stability. However, it's important to remember that the bonds are backed by the financial resources of the federal home loan banks and not the US government. The federal home loan banks are crucial to housing, and they are likely to be very stable. With the joint obligations and backing by a government organization, this seems like a safe but not extremely profitable investment. Therefore, I would set a price target between $95 and $100. If you found this video helpful, please like, subscribe, and comment below. Thanks for watching.